everyone. We're gonna wait a couple minutes to get started. Can you guys hear me okay? If you guys could just send a quick message here on chat just to let us know the sound is good. Okay, thank you. Okay, sound is good. Thanks, Christopher. Thanks, everyone. Okay, I think we're good. Yeah, so let's get started. Thanks again, everyone, for joining us today on our webinar about cryptocurrency taxations in the United States. Today, we're gonna have an informal conversation. I'm gonna bring two guests here with me today. And basically, we have compiled some of the questions that we have received from our clients, friends, about crypto in the US, how to report for tax purpose, and other questions that we're gonna go through. So I'm happy that you guys are able to join. And let's get started. Hello, Mona from New Jersey. Thanks for joining us. Welcome, everyone. Okay, so we're gonna get started. First things first, let's talk about disclaimers. This is not a tax advice or any type of legal advice or financial advice. So just so everybody's on the same page. By the way, if you have questions, feel free to type it on the chat box. English, Portuguese, Spanish, whatever you guys prefer, we'll be able to handle. So send us over. Okay, this is a quick agenda for today. We're gonna have a quick introduction about Drummond, our services, our guest speakers, and then we're gonna go over a quick overview on crypto assets. We're gonna take a deep dive on US taxation on crypto transactions. We're gonna talk about capital gains, ordinary income, mining, staking, all the good stuff. It's a lot to talk about today, so we're happy to explore some of these topics. And we'll talk about crypto compliance, which is a big thing. We got some fresh news coming up, and we'll go through them. And we're going to talk about NFTs, some concepts and regulatory aspects. And then at the end, we're going to open for Q&A. So we hope you guys also can share some of your comments and questions. All right. Real quick introduction about Drummond. We're Drummond advisors. My name is Michel de Amorim. I'm one of the partners. I'm based in Miami. We are a consulting firm specialized in accounting, tax, and legal transactions. We have offices in Brazil and the United States. Our team is basically formed with accountants, lawyers, consultants on the focus on international transactions. Right, so our offices are in Boston, New York, Miami, Orlando, São Paulo, and Belo Horizonte. We were founded in 2010. We have served more than 3,000 clients, and we currently have more than 170 employees. Okay, so let's meet the team. First, I'm gonna bring Camila Cabral, our tax consultant. Hello, Camila, thanks for joining us today.
Hi, Michelle. Hi, everyone. It's a pleasure to be with you today. I am a tax consultant here at Drummond. My specialization is in tax law and international tax law, and I'm a part of the tax planning and transfer pricing team.
And you are a crypto specialist, right?
Almost there.
Almost there.
Not okay. Just like that.
Okay. And now we're bringing Thomaz Mattos, who is a legal consultant here at Drummond. Thanks, Thomaz, for joining us today.
Thank you for having me, Michel. And I'm based in Brazil. and I work with corporate law for 8 years, and I'm interested in crypto not just as a lawyer, as a law consultant, but as an investor. So I hope to learn a lot with you today here.
No, thank you. We're gonna learn a lot from you, Thomaz. I've heard you're a top gamer, so we want to hear about your experiences in the gaming industry and whether your investments are doing well, because I know it's tough time out there, you know, like, but we would like to hear, you know, about your experience and also some of the legal matters that are relevant in the subject.
Well, those are tough times, and thing is, Bitcoin, the Bitcoin dips drags everything down. So it's a tough time, but as we can see on the charts everywhere, the tendency is that it will fix with time. So this little bit of optimism and a little bit of faith, of course.
Yeah, there are a lot of FOMO, right? The fear of missing out in the space. Yes. And we see when Bitcoin hits $69,000, a lot of people want to buy, but when it hit the bottom, you know, like a couple of weeks ago or last week, people are just trying to sell. So, I mean, same thing with the market, right? The financial market. But I guess, I mean, we're gonna go through some of the details and hear from you on the topic. So, Thomaz, let's get started. If you don't mind giving us a quick overview. I mean, we have a nice audience today with different backgrounds. So we have some specialists and, you know, some people that are new into the crypto industry. So we'd love to hear your thoughts, kind of like, you know, just a quick introduction on the topic, and then Camila, feel free to join Thomaz in the discussion.
So definitely I will start a few steps below, even because we have to assume that not all of our viewers are familiarized with the terms and cryptocurrency at all. So first things first, cryptocurrency is not legal currency, right? It's considered property for the US, the IRS. So since it's not national legal currency, where does it stand? Where is it trade? So I think it would be good if I give a brief overview of what are blockchains. There are the networks where the cryptocurrencies are exchanged. So a blockchain is a distributed database that is shared in a computer network. So why was it built like that? We can't talk about cryptocurrencies or coins or tokens without talking about the blockchains, because the blockchains were built to justify, to enable the currency to be exchanged in a manner that is secure and transparent and safe. So as the name suggests, it's a chain, because every time a transaction is completed by the network of computers, the nodes validate the exchange, it joins the network. It's like it's annexed on the list of the blocks, and the next validated information gets annexed just after it, in a way that you can't modify the information that came before unless you modify them all. That's basically what it grants the security of the chain, is that you can't really change it, right? So how are these transactions made? So when a company or an individual wants to exchange currency on the blockchain, it emits a request, maybe for transferring currency or for making a purchase. And then the whole network validates it and puts it back on the chain before he has the hash. It's what we call it, hash. It's a code, it's a computer generated code that it certifies that that transaction was validated by the whole network of computers. So that's blockchain basically in a very basic and surface level description, but I believe that's enough that we can use it for today's purposes. But then DeFis. DeFis are decentralized finance, and using much of what I said earlier, it's the intention is to enable people to make transactions with the least amount of intermediaries necessary. So exchange values without a broker, without a banker. And that's made possible by the automatized verification systems of the blockchain. Then we have, forks and hard forks. I believe Camila will go deeper on these concepts as they are important for the taxation, right? Because they, how can I say, they validate, they influence on how much you can make from, so you have an investment contract. The forks are manners in which this contract can be changed, and that affects your gain, your exchange. Staking and mining are other ways in which you can receive currency. Mining is how the blockchain rewards you for participating in the validation process of the information that it's annexed to the chain. And staking is as well a manner of rewarding people who help to validate machines, to validate the transactions, but not in the same way as mining. As mining, your computer is producing the hash to make the validation. The staking it's not dependent on the power of your machine. It's more how we use the APY. It's the investment, how you leave the data in the network.
So basically on the staking, but by putting your crypto back into the network, you get rewards in exchange, right? Like, so that's kind of like, it goes back to the validation process that you mentioned earlier, right?
Exactly.
So, yeah. No, I mean, there are a lot of new terms, and especially for us on the accounting side, I mean, everything here is relatively new, including, regulations, and Camila's going to talk a little bit about it. So now we are dealing with clients coming with a huge volume of crypto transactions, and a lot of the transactions are related to hard fork, soft fork, staking, mining. So we gotta be familiar with all these terms, right? So that's kind of like, that's what I think it was very good, your introduction, and kind of give us a little bit of a base so we can go to the next slide. And now I'm going to bring Camila, where, here we're going to be talking about some of the challenges that we're going to face regarding crypto transactions and the taxations in the US. Camila, the floor is yours. You want to move forward?
Well, so regarding the guidance we have up until now on crypto taxes, there is no disposition on the Internal Revenue Code or the Code of Federal Regulations. We do have a notice from the IRS that is from 2014 and only mentions the word virtual currencies. The definition of virtual currencies is a representation of a real value through a digital asset, and it's been applied to cryptocurrencies and the other assets such as tokens. So this is the only formal source we have up until now. And this notice treats the virtual currencies that here we're going to refer to to cryptocurrency as property, as personal property in the US for federal tax purposes, and established that the guiding principles would be the ones applicable for capital gains at first. I say at first because there are some cases in which the treatment is the one applicable to ordinary income. So regarding the transactions, the main transactions I see here, we can have a jump start with the use of crypto to pay for goods and services. So isn't it possible? You can purchase like a Starbucks coffee with crypto, or pay the services of a decorator with crypto. And because this crypto is treated as a property and therefore a capital asset, at the moment you use this crypto to pay for goods and services, you will have a capital gain or loss. A quick reminder here, I don't know if everyone is aware, but capital gains in the US have different tax rates. So if you hold the assets for less than 1 year, the rates vary from 10 to 37%, but if you hold the assets for over a year, the rates are 0, 15, or 20%. We still have the net investment income tax of 3.8% that may be applicable here.
Camila, quick question. You're saying that I'm gonna buy my coffee, but then I gotta pay tax?
Yes, regarding
I could pay, capital gains tax just by buying my coffee?
If you use crypto, yeah, that's the rule from the IRS. You are disposing of your capital asset, so you are having a taxable event that's going to be taxed as capital gain or loss. The gain or loss will depend on your cost basis. And in this case, the cost basis will be the fair market value of the crypto coin. I'm going to refer as crypto coin here, on the date you purchased the goods or services. So let's suppose you bought 2 Bitcoins on Monday with a fair market value of 4 each. I know it's a dream, but let's just make believe here. And then on yesterday, you used 1 Bitcoin to pay for Starbucks coffee, but the fair market value of the Bitcoin was 2. So in this scenario, you have a loss. But if the fair market value of the Bitcoin on yesterday was 6, you would have a positive difference of 2, and then you would have a capital gain. The same works for services. But if you are the one receiving the cryptocurrency, the crypto coins for the services you provided or the goods you sold, there is a difference, whether if you're selling the goods or rendering services. If you receive crypto in exchange for the provision of services, even though you were receiving a property, the tax event was the provision of a service, which is taxed as ordinary income. Your basis in this situation would be the fair market value of the coin in US dollars when you receive the coin. So let's suppose you render an accounting service, for example, and receive 1 Bitcoin that has a value of $400. Then you will apply the ordinary income tax rates on $400. And if then you decide to sell or exchange this Bitcoin, the $400 would still be your cost basis for the second transactions. And so still about, go ahead.
No, just on that matter, it's a very interesting thing I read this week. Regarding NFL players who chose to receive their salaries on cryptocurrencies. One example is Odell Beckham Jr. and I believe even Aaron Rodgers. So they received on the last few months, part of their earnings in cryptocurrency, but Bitcoin was in almost its all-time high, and now it's low. But they have to pay the taxes based on the value when they received. So it was like a bad deal for him, because when it lost almost 40% of its value, but he had to pay the taxes based on when he received it. They were way high. So he lost on the two ends of the tributes.
Yeah, I'm aware of Odell's case. He has a contract with the LA Rams, and this contract is Bitcoin based. He received, I think, 75 Bitcoins for the year as salary. And it's really important to keep in mind here that an employee receiving crypto is just like employment income. You're going to have like Social Security, the Medicare, ordinary income tax rates. And if you are an autonomous rendering services and receiving crypto, you'd still be subject to self-employment income in the US.
Guys, just I have a quick question here from YouTube, Tati Barreira. She's mentioned that she's asking, do we have to report the crypto when realized or when traded at all times? I guess what she means is that if she needs to pay tax on the unrealized gain, I think that's, or I think that's what she means. So Tati, just to answer that question, you don't pay tax on the unrealized gain. You only gotta pay tax on that transaction once you actually realize the investment, right? So if you bought Bitcoin and you never sold it, you don't have any tax obligation with the IRS. You will have it once you sell, and if you sell at a profit, that's when you gotta report that capital gain. So I think I hope that answered your question. If not, just send me another comment here, and I will present here to the team. Sorry, Camila, didn't mean to interrupt, but I just thought it was relevant to what we're discussing. We're getting more questions. We're gonna go over pretty much the questions at the end of the presentation. But yeah, so this is very interesting. I mean, because what you're saying is that the timing, so the income must be reported on the day it was earned, but then he's got to pay taxes later on, or whenever. And on the case that an employee is getting his wages via cryptocurrency, he's still, as you mentioned, he's still got to pay all his employment tax. The company has to pay the share of employment tax, and the employee as well. And if the value of the coin goes down, well, too bad. I mean, you still got to pay tax on the income on the date that it was earned. So this is a point that it's very relevant for the ones that are doing this type of transactions using crypto.
Yes, and if the case involves the sales of goods, for example, and the receipt of crypto, which is basically a property exchange, the taxation will be the capital gain or loss. And again, the calculation will consider the cost basis on the property the person already held and the fair market value of the crypto receipt. I think it's relevant to mention, I know there are a lot of people here that are aware of this case. Recently, we dealt with a case like this for a client. He sold real estate held as capital asset, and then the payment for the sale was received through crypto. We had to look at his cost base regarding the real estate, which is the amount he paid to acquire it, and then the total amount he received in crypto. In this case, he had a capital gain because he received an amount of crypto that was way higher than his cost basis on his real property. But he used two different exchanges that calculated his basis in two different ways. One of them calculated the exchange in like a zero cost base, so he would have a relevant capital gain in the US. and the other one considered the fair market value of the crypto receipt, which he received. And this is the one that he should consider. If anyone engages in this type of transaction, if your crypto exchange reports your cost basis as 0, this is incorrect according to the IRS. Your cost basis is the fair market value of the crypto coin or token you receive on the date you received. This is why it's really important to keep a tracker of this transaction.
That's true. And Camila, the only way you get a 0 cost base, and we're going to talk a little bit about it, is when you earn your crypto. For instance, if you are playing a game and then as a reward you earn your token or crypto, then you really have a 0 base and you have a possibly ordinary income, right?
Yes, we're going to talk about this later. I have my personal concerns. There is no guidance from the IRS or any authority regarding this matter. I have my personal thoughts on this, but I am not the IRS, so we just have to wait.
Well, yeah, so if we can correlate with the casinos and the gambling and, right? I mean, somehow, right? So that's kind of like, but that's a good point. I mean, again, everything we're talking about a topic that's relatively new, and the IRS is kind of making adjustments in terms of reporting. And this is a big thing because not necessarily the exchange, they have the 1099s like we would if you would be doing a financial investment, right? So it's on the individual or the company to keep track of their basis and their cost basis and the actual gains or losses that they are having. So this can be quite time consuming, although there are a lot of tools out there that are facilitating that process, right? And they use APIs to connect with the different crypto exchanges. And I highly recommend all the CPAs and accountants to enforce their clients, if they can, on using those tools, because otherwise a client's going to come with a list of transactions, and it's going to be on the account to calculate the gain or loss, and that's just going to be a significant amount of work. But anyway, we'll see how that's going to play. I know that this tax season there are going to be a lot of cases with significant transactions. So one of the questions that we have here, Camila, is regarding day trading. So there are people day trading with crypto assets. So how do we deal with capital gains when you have a day trading activity?
There is no guidance by the IRS regarding this matter. In a lot of transactions, we are having analogies with stock market, but this is quite tricky. It's crypto to crypto transaction. You may recognize, if you're conservative, you may recognize a gain or loss during your day. I see a question here that I think is quite relevant. Michel, we can bring this question right now. It's from Alcides Ferreira. At how to calculate your gain or losses, LIFO, FIFO. You can deem which units are being sold if you can track them, if you have documents to support this. If you don't have a tracker, you can't support which units are being sold or not. The method applicable here would be first in, first out. Which
so
is
again, keep track of your assets and make sure that you keep track of the transactions that you're doing, because if you're audited, there are some level of subjectivity here that we may be facing, right? So you better keep the right documentation.
Yeah, I think it's also relevant to mention the exchange of real money for crypto. This was a question we received in our social media profiles. It's just to clarify, when you use your own money, your dollars, to transfer to a crypto exchange and buy crypto coins or tokens, you don't have a taxable event. It is like transferring money to an investment account to buy stocks. In this first step, you're only exchanging money for property and establishing your basis for future transactions. This basis also considers similar factors like the ones involved when you buy stocks. You have the fair market value of the coin, the fees, the commissions, other costs. Just like if someone here is familiar with stock marketing, this person will understand what I'm talking about. When you buy stocks, you have commissions, you have fees. The same works with crypto coins, cryptocurrency. You're just exchanging money for property. You don't have a taxable event here. And if later you decide to exchange your crypto coins for US dollars, it's the reverse situation. You must consider the cost basis and see the fair market value of the coin and the date you do this, if it's higher or lower. It's quite indeed similar to the stock market. If you buy stocks from Apple, for example, for $10 and then you sell it for $8, you have a loss. But if you sell it for $12, you have a gain. It's similar with crypto. Just exchanging money for crypto is not a taxable event, but the opposite is a taxable event.
And Camila, this is a great point, because merely transferring cryptos from one exchange to the other, it's not a taxable event, right? I mean,
right.
Basically, if I have Bitcoin in one exchange, Coinbase, and then, for instance, I want to transfer over to any other one, KuCoin, for instance, yeah, that's not a taxable event. But that brings to another topic, which we're going to talk later on, but it's compliance, right? So a lot of these crypto exchanges, they are not US based. So if you have foreign assets, how do you do about reporting to the IRS? Doesn't the IRS want to know if you have foreign assets? So how do we report those?
Yes, exactly. Having multiple wallets and addresses or accountings that it belongs to you, if you exchange crypto through all these addresses, it's not a taxable event. I think regarding this main transactions, we covered it all. If you have further doubts, you can send it here, and if we're able to answer at the end of this webinar, it will be a pleasure. If not, we'll answer you on email maybe.
Sounds good. So let's move forward. What about assets received through hard fork and staking?
As Thomaz explained before, a hard fork is an event that there is like an update in the crypto coin or token, and then I'm going to use a very informal expression here. It gives birth to another coin or token, and then you receive it. The way you receive it, it's called airdrop. You basically receive it for free, somehow, for free. This is a taxable event. Hard forks are a taxable event because they modify your original situation with your coins and your tokens. So it's going to be a taxable event. We have discussions in tax courts in the US, but it's something very, starting to happen right now. But up until now, the hard fork, the tokens or coins you receive through hard fork is considered ordinary income. And for federal tax matters is subject to rates that vary from 10 to 37%. As for staking, Thomaz explained the staking process, and I said I had my personal concerns regarding staking, but the rewards someone receives through staking process is also treated as ordinary income. So every time you receive a rewarded token, you're going to have a taxable event. You're going to consider the fair market value of that date, and then you're going to apply the rate that varies from 10 to 37%. This is just going to consider your adjusted gross income on a quarter basis in the US.
So it's like interest income that you receive from bonds, right? Like,
very similar, very similar. Staking is very similar to putting your money into, I don't know, investment funds, and then you receive interest, or some kind of investment, you receive interest. And hard fork is like a stock split. You know, when your stock splits into two, it's kind of the same situation. It happens with hard forks. There is also something called soft fork, but it's just a game update. It doesn't change anything in your assets. So it's, if you go through a soft fork, you are not going through a taxable event. Just hard forks are taxable.
got you. Thank you. Interesting. I saw here some other questions popping up. Guilherme Batista. If you have to pay capital gains when applicable, can you carry any loss into your income tax return? Yes, right, Camila. If you got a capital loss, you can use up to $3,000 in the current year, and then you can carry forward. So again, you got to keep track of short-term and long-term. That makes a big difference for tax purpose. So, but yes, you will be able to carry forward any capital loss according to the IRS rules. Okay, let's talk about crypto compliance. Camila, here are some of the forms, right, that people need to be familiar with. I mean, some of them we know for a fact that they have been around for a while, right? The 1040s, 1040s NRs, 1120s. But now, if the individual companies are trading crypto, they got to report their capital gains, right? And that's on Form 8949. And then Form 1099, this is something new. I mean, not the 1099, but the crypto reporting on 1099. This is something that I know President Biden signed the infrastructure bill recently, and there is an expectation that the crypto exchange will start reporting 1099 to their clients, but only after December 2023, right? So don't expect to receive your 1099 with your crypto transactions until then. So you gotta keep track of your own transactions. And some of the exchanges, especially the US based, they do have some sort of tax report, tax activity somehow. But again, that's far from a 1099. So you got to do your own math. And as Camila mentioned, I mean, we've seen some of the reports that are not consistent at all. I mean, zero basis cost, that, you know, that client would pay a huge amount of tax if he would file a tax return considering a zero base. So you got to make sure that you double check, triple check your cost base. So, because that's how you're going to calculate your gain. So if you don't have that information, then you can be in trouble. Camila, any other comments here? We'll talk about Fbar and Fatca for assets held outside of the US. And this is tricky because a lot of times you don't even know where these crypto exchanges are based, right? And if you talk about DeFi, I mean, who knows where these companies are based, right? It's kind of crazy.
Yeah, exactly. That's a burden for the taxpayer to report all this. We do have the IRS released a note and the new form where you have to report your cryptocurrency transactions. Here we have the 1040 is your individual tax return. You can report your ordinary gains and your capital gains or losses. Capital gains or losses Schedule D of your 1040, along with your Form 8949. It's the disposition of capital assets. And if you hold foreign assets, there's another form. And it's basically all the compliance burdens someone that invests in crypto assets in the US has.
Yep. Okay. So let me see if there are new questions. There's one question here regarding investing in crypto through an IRA. This is from Luis Nascimento. Luis, I know that there are a few options now. It's quite new that you have investment funds and I mean ETFs that are crypto related, and I do believe that there are now tools where you can invest in crypto through your RIA account and therefore defer the payment of tax on the gains. But again, that's relatively new. So I would double check your case. I mean, special, like with your tax advisor, just take a closer look. I mean, there are limitations on the RA, but yes, I mean, the concept of the RA is that your money will be able to defer tax during that period that the money is invested. So we have another question here. Yeah, let's move forward, Camila, for now, and Thomaz, and then we cover the other questions that we have at the end of the presentation. Okay. NFTs, Thomaz, that's with you. Want to give us a quick overview?
Sure. So, as the name suggests, and contrary to what's the case with the coins, NFTs, they are not fungible tokens. So, regular cryptocurrency like Bitcoin, Ethereum, they are fungible. What does that mean? That means that 1 unit of Bitcoin can be exchanged by any other 1 unit of Bitcoin. So it's fungible. The intention is for it to be a coin. So when it's not fungible, it means that it represents an asset that's not equal to any other. So it has its hash rate in a sense that it's unique, and its uniqueness can be verified on the blockchain where it's hosted, where the transaction is hosted. And that makes it exclusive. Basically, that's for the non-fungible aspect of it. So, and then where do we go from this concept? So here's the deal. An NFT, it can be a piece of art, it can be a music, anything really, a picture. So, but considering that it's represented in the blockchain as a unique asset, people are using tokenizing, digitizing every type of asset. So here in Brazil, we have cases of real estate being represented in NFTs. Like we have the real estate registry, but the property is further consolidated and exchanged, not the property, but the right of use. It's being exchanged and negotiated in blockchains. So it's a big deal for markets now to use the blockchain as a means to validate and provide transparency for the property of different types of assets.
This is quite interesting. And I know, Camila, you do have some experience with NFTs as well, right? So what do you think about it? You want to share a little bit? I mean, without getting into the details.
God, I do. I have, just like Thomaz here, we have a common experience with the play to earn game in NFT environment. Thomaz, you want to share your experience with it? Mine, it's not that great.
Yeah, the thing is, as it's not really regulated, I mean, it's decentralized. So obviously, there are a lot of people trying to take advantage of it. But my experience is mixed. I've seen some good projects, some bad projects. But overall, it's embryonic kind of enterprise. So it's really on these first steps. As soon as big players start investing, pouring money, and advertising, it will grow, of course. Maybe not with the gains that we see today. I used to say with my friends, well, it's too good to be true. Either it's illegal or we'll soon stop being this good.
Yeah, we've seen some of these NFTs paying the return on the reward. I mean, like crazy amounts, like, okay, 1,000,000% a year, but then the value of the NFT goes to nothing, right? Like, and then what's the point of making 1,000,000 on nothing? But yeah, so these are all taxable events potentially. I mean, if they do have value, and the IRS wants to know. I mean, there is specific questions in the forms whether you do have investments in crypto, and so it's a matter of time that the IRS is going to start asking for all these crypto exchanges and these DeFi projects to report these transactions, so they can kind of like just trace it back to whatever the individuals and companies are reporting in terms of gains or losses. So we have one comment here. I'm sorry, go ahead, Thomaz.
No, but just to contribute to what you're saying, and even then, and even if the IRS decides to make audits for it, it's very hard to trace the wallet address. I mean, at least from the perspective of NFTs as parts of a game. When I play
for the DeFi space, forget it. I mean, how you track it down. I don't know how many tokens there are out there, but it's probably a lot, right?
Yes.
Like, and that brings another topic, Thomaz. If you can share with us, how does the SEC take a look at all these tokens? I mean, ultimately, these are companies raising funds through their tokens to fund their operation, right? So isn't it, are we dealing with security regulation issues here?
Yes. The thing is, the SEC didn't put out like official positions on it yet. So the advisors are using a very case-to-case analysis of what we call the Howie Test, based on a US Supreme Court case. But what is the Howie Test? To define if a token or coin, it's whatever we call it, a digital asset, is it's a security. We have to first see if you invested money in it. Two, if you have, if it's a enterprise, like a shared enterprise. And three, if you have expectation of profit derived from the managerial or entrepreneurial efforts of others. Oh, if there's an executive behind the project, like the driving force to generate profit, so you can profit from it. So although it seems pretty easy to spot when it's a security or not, it's rather difficult, and because an advisor can make a judgment, but the SEC can second guess it. Like, what's the influence of the managerial and the executives on this project? So for me, that's the most difficult point, because some cases for me are clear, like Bitcoin, Ethereum. These are coins. The intention, when they were created, the intention is that to be was for them to be currency. So their value is not dependent on the result of a company. It's not dependent on the action of an executive. They exist. Their value will be the possibility, their capability of being exchanged by goods and services. But some tokens, especially companies that are tokenizing and digitalizing their securities, some of them are clearly used as shares or stocks would normally do.
They're raising funds for their operation, right? Like it's like they're bringing equity investors, if you would, right?
Yes,
like to their projects. So, and I think that's kind of like that's the argument that the SEC is using for the Ripple case. I mean, that's the famous one, which it had a significant impact in the price of the token. Recently, and it still hasn't been, it's still under discussion, like back and forth all the time. So yeah, I mean, there are a lot to go ahead.
They're going a step further even, because when a token or a coin is first offered in the market, we see the figure of the ICO, the initial coin offering. And that by itself, for some of the lawyers involved in these SEC cases, is enough to qualify it as a security, because many of the SEC laws were made with the sole intention to protect the consumer, to protect the investors. So when you make an offering, and you're not making sure that you have only accredited investors, and you don't file a Form D. So the thing is, even when you have so-called accredited investors, sometimes they're used as pools. They are called ICO pools, where accredited investors, they reunite funds from non-accredited investors so they can make the investment for them. So it's like a caveat. It's like a way to contour these prohibitions. But the SEC is from each day they're paying more attention to this. So this year we already have the first case. I'll just check. Yes, Crowd Machine was sued by SEC for allegedly fraudulent and unregistered ICO. So in these cases of ICO, the SEC it's pretty regularly considering to be securities.
Yes. So yeah, if you're planning to release your own coin, just be aware of the SEC. Not only tax matters, but also legal and security matters. So let's go through some questions here. We have an anonymous attendee that asks about stable coins, if there are any differences. Camila, you want to take that one?
Yeah, regarding stable coins, they are based on real money, like dollars and euros, but considering it is a coin, and since the IRS hasn't released any formal guidance on this, we tend to adopt a conservative position here to
same treatment, right? I mean, it just is not as volatile as a regular coin, right? But you might buy at 99 cents and then it goes to, like 99.5. There's still a gain or loss transaction. The amounts are just, just dealing with a smaller gain or a smaller loss.
It's really hard to discuss this, Michel, without a formal regulation or any provision in the Internal Revenue Code. It's just we're here taking premises.
Yeah, so, and based on our opinions and how we are handling this type of situation, always on the conservative approach. We don't want to get anybody in trouble. So we go by the regulations that are currently out there, right? Another comment here, question from Pedro, and Pedro is a longtime client of ours. Pedro, thanks for joining us today. Pedro is saying that he's an early adopter, and he's been trading, a quite significant volume of crypto. And he said that he found some tools to track the profits and gains and losses from these transactions, but there's always missing something, right? Like, and again, Pedro, I mean, everything is new in this environment, right? So you gotta keep track, you gotta have your own control. And I know it's hard, I know it's frustrating. And Pedro's asking if the IRS has a better tool or a suggestion on this. And no, the burden is on the taxpayer. You got to keep track of your own coins and your own transactions. And if the IRS comes and audit you, and you don't have, the proper support, you might be in trouble. So until we have all these regulations going through the exchange and so on, there's not much the IRS can do. They either rely on the information the taxpayer is providing, or they go ahead and they audit, right? And then they want to, they might ask for more details, statements from the exchange and so on. Again, this is blockchain, guys. Everything is traceable. So if the IRS wants to see a transaction, as long as, the subpoena or whatever, or ask for information from you, you got to go and provide the details. So there's not much about that, but again, I think these tools, they help. CoinTracker, Coinly, Pedro mentioned a few. They're out there. There are tons of tools available right now. And literally they use APIs, they connect to different crypto exchanges, but not all. So if you have some hard wallet over there, and of course, that's not gonna be in the report. So just keep that in mind, and just try to have your own log and keep track of your own things. Because as Camila mentioned, the exchange, they might report some of the transactions on a zero cost base. They might make some mistakes. They're not required to provide any support to the IRS. That's until December 23. So you got to keep track of your own transactions. Guys, I think we are approaching to the end of the presentation. We have one person here wants to receive a copy of the slides, and I'm sure that our communication team can reach out to you guys who want to have a copy. Please send us an email. We'll be happy to share with you. Appreciate it, everybody, being with us today. Camila, Thomaz, thank you so much. Aline, who helped us in the background, thank you so much. This has been great. If you guys want to share your final thoughts, and if anyone has a final questions, I think we still have 2 minutes here, 1 minute.
Michel, I think regarding NFTs and the taxation of NFTs, again, no formal guidance by the IRS, but the thing with NFTs that I think it's relevant to mention here is that it's likely to be considered a collectible. So if you have an NFT and it's considered it's likely to be considered, right, a collectible. And if you dispose of this NFT, your capital gain rate will not be at the top of 20%. It will be higher. It will be 28% because it's the one applicable for collectible items. And there are a lot of discussions regarding the taxation of the creators of NFTs. I know a lot of people are curious about this. We received questions about this. And because when someone creates an NFT, this person, like Thomaz said, has kind of the rights of this NFT. It's almost treated like an intellectual property that is protected. And then we have the first sale and the subsequent resales, which can be perpetual. And the income stream from all these sales, they can come from all over the world. So it's going to be a real challenge for tax authorities to establish regulations regarding NFTs, marketplaces, and I think the easiest one to deal with is the person that buys NFTs and then transacts with the NFTs. It's a crypto to crypto transaction, and it's just taxable, just like the other crypto ones. And just a final remark here, we have a doubt from Guilherme. I can't see his last name.
Guilherme Batista.
Yeah,
I was about
Guilherme,
to read
you are
that one.
100% right. If you receive an amount for services you rendered, you have to pay your ordinary income taxes. And then if you sell them with a loss, you just have a loss. You are 100% right on what you wrote here.
Yeah, Guilherme, don't forget the self-employment tax if you are self-employer. So you need to take that into consideration. Okay, so on the 100K, you'll be subject to your income tax and self-employment tax, like you would if you receive cash.
Yeah, and for people that play, play to earn games, just like me and Thomaz, we also don't have a formal note by the IRS. So technically, the provisions regarding cryptocurrency are the ones applicable. So this is staking and play to earn games are my personal concerns. This is a personal view.
You got to report again. You got to report it.
You get a report. If you earn tokens every single day, if you follow the IRS rule right now, you have a taxable event every single day. And this is why I am still worried about it, because it is burdensome for both the taxpayer and the IRS. Imagine if you work in the IRS and you have to review 352 days of token transactions with fair market values that vary every single day. It's very burdensome. I had a very nice conversation with a friend about this, and he made a parallel with the stock marketing again. He came up with a situation in which you transfer your money to an investment account, and then you buy stocks, and then you receive dividends, and these dividends are taxable. And then you just decide to buy other stocks with your dividends instead of transferring them to a personal account. Then I asked him, these dividends are not properties, and tokens are treated as properties. Dividends are dividends. They're money that flow into your account. So you don't have a taxable event when you decide to buy new stocks with the dividends you received that were already taxed. I have a personal view on this, but again, I am not the IRS. This is just part of a personal study that I may soon release or not. And we just have to wait for further provisions.
I mean, the IRS see as you are liquidating that asset, right? And then convert, as an example, we use in the coffee. If you go to Starbucks and you want to buy your coffee with Bitcoin, literally the coffee is priced in US dollars. So you got to convert, technically on the IRS mind, you're liquidating your Bitcoin into US dollars to buy your coffee. Therefore, you have a taxable event if you have unrealized gain. So that's, I mean, that's the base of everything, in terms of US taxation. So that's my personal view. Thomaz, we want to hear yours, and I think we are wrapping up pretty soon.
Yeah. I only want to add up because when I hear you say about, if you buy a coffee in Starbucks with Bitcoin, I can only remember the man who bought 2 Papa John's pizzas with 10,000 Bitcoin, which amounts to $350,000 more or less for 2 Papa John's pizzas. And so it's a hot topic. It must be in our radars.
Million, right?
Yes, $1,000. $1 million.
Yeah, I bet that's the most expensive pizza ever. I mean, yeah, and he spent a couple of days trying to find somebody who was willing to pay for those pizzas, right? So we have
exactly.
Bitcoin Pizza Day happening soon in May. So that's an interesting story. Thanks for sharing that, Thomaz. Guys, thank you so much for all the time. Just one last comment here. I'll see this recommended that so for the ones that are worried about keeping track of all the transactions, most of the crypto exchange, they have an option that you can download the ledgers, and then hopefully the download is in Excel file, so you can calculate it. I've seen some of them in PDF or cities. So client comes to us with a couple, 100 pages of PDF files and say, okay, here are all my crypto transactions. I mean, they can expect some, fees associated with those transactions, right? Because again, this is it's relatively new, and as I mentioned before, I mean the burden of the everything, all the support and documentation, keeping track of everything, it's on the taxpayer, not on the IRS. So not on the crypto exchange for now. So yeah, I mean we got to deal with it. Guys, thank you so much. This has been great. I appreciate it. Looking forward to the next webinar. We're going to be talking in a couple of weeks about taxation in Brazil and in different aspects as well. So you all feel free to join us. We appreciate everything. Thanks so much. Have a good one.
Thank you, everyone. Good night. Good evening.
Thank you.